I want to thank everybody for joining me today. Today, I want to talk about using irrevocable life insurance trust. Some of you may think this is just about estate taxes, but ILITs can be so much more and can be such a big part of our planning process. I review a lot of life insurance policies, and I can just see, obviously, many of these people didn't take the time to think who should be the owner of the policy. If you look at the issues that need to be addressed, do we need to address estate taxes, creditor issues? Do we need the business to own it for buy-sell purposes, key man purposes? Do we want to have more control over the family distributions and control over the principal and income after death? All of these should make us, stop and ask who should be the owner. And we have, multiple choices: individuals, revocable and irrevocable trusts, the business. All of these could be good options if we take the time to really plan and think it through. A lot of times I look at planning as a balancing act. There's a lot of issues that we have to look at in the planning process. And all of these, there's a little bit of give and take in making sure that they're balanced properly. It's, if you think about it, if we're doing a trust, how much do we put into the trust? What assets do we transfer? What about the step up in basis for the assets that are in the estate? What about lifetime needs, for the spouses, for, their assets and income? All of this comes into the planning process, and we need to be flexible enough and spend enough time with our clients understanding their goals and objectives to make sure that we get the right result. As you look at irrevocable life insurance trusts, I think the big part of this is out of the estate. And we want it out of the estate, but that might be for asset protection. It might be for estate tax planning. It might just be, the way to balance out control for the estate. But think about if we can have an irrevocable life insurance trust with lifetime spousal access. That might benefit more of our clients than we really think it could be. So let's take a look. Let's look at how we would set up this trust. Well, typically we're going to set up a trust, and in this case, I have a husband setting up for wife. This could be wife for husband, or parents for kids. But in this case, the husband as the grantor is the person that's going to decide how this trust is drafted. What do we want to include in the trust? What provisions? They're going to name the trustees, the beneficiaries, and put all of that in place. And if we want it to be, a grantor trust, that means it's taxed back to, in this case, husband during his life, so that there is no income tax effect here, but it creates a way to get it outside of the estate. And now we have it in the wife's trust. We can make the wife the trustee of this trust, but during her life, she can have the spousal lifetime access. What does she have access to? The principal and income of the trust. So if we have a life insurance policy in this trust, then the trustee, wife as trustee, can access that policy income tax free, and then the wife can pull that money out of the trust income tax free. So there again, we've now created a trust that is outside of the estate, both for estate tax purposes. It's outside of the estate for creditor purposes. We've now protected this policy away from the bad things that can happen in the planning process. And now we've created access for the spouse to be able to, use that money if needed. A lot of times it's not needed, but what if? And there again, we could have two policies, two trusts, one for husband, one for wife in this case. We just have to make sure the trusts are not identical. So that creates some problems with some IRS rulings. Now you come in and say, after the wife passes away, now we can pass it to the kids. We can either pass it outright to the kids, or we can pass it continuing in trust for the kids. There again, estate tax free. But I look at this and think, well, if we leave it in trust for the kids, not only have we created asset protection for the wife while she's alive, Now we've got asset protection for the kids if we keep it in trust. If we distribute it out to them, that policy or the proceeds of that policy are going to be subject to the creditors of the kids. And so we can add that extra layer of protection in here. Again, we're not talking just for estate tax purposes now, but we're adding creditor protection for husband, for wife, for the kids, for grandkids, and on, as long as we want this trust to stay in force. The other thing that I look at is, what can we do? What can we do for mom and dad in their planning in this case? And we can add perpetual values, incentives into this trust that, can incentivize future behavior by the kids, the grandkids, or whoever the beneficiaries of the trust. So we can add, special needs planning in here. We can add, charitable planning. We can, I've had clients where they wanted their kids to be encouraged to work, but they've added a salary match to it. So for every dollar they earn, they get $1 from the trust. Whatever it is, whatever behavior we want to incentivize, we can have those values in the trust. Just as we add incentives, we can also add the disincentives into this trust. So now mom and dad, if they were alive and they had a child with a drug problem, they probably wouldn't continue to give them money, but they would get them help, get them into drug rehab, do those things which would help that child. We can add those same provisions into the trust to create this, perpetual values. How would mom and dad use the money if they were still there? How would they help their kids and their grandkids and on if they were still there? We can add that language in the trust if we just put a little bit more effort into the planning. One of the things I like with trust planning is we get to pick and choose which state to set these trusts up in. So even though we might be in a state that is, not creditor friendly, we can move that to a state like a Nevada, a Wyoming, a Delaware that, adds creditor protection. And there again, this forum shopping allows us to get to the right state to make sure our planning stays in force. The only thing that we have to have in a trust situation is we have to have at least an administrative trust in the state of the jurisdiction we want to set the trust up in. Once we have all of that set up, now we have to look at how do we fund the trust? And this brings into account the gift tax. We don't want to inadvertently trigger gift tax. So we can use the annual gift tax exclusion. There again, use it or lose it. If we do annual gift tax exclusion for an irrevocable trust, especially a life insurance trust, we want to make sure that we have the crummy notices going out on an annual basis to make sure that's taken care of. We can use lifetime exemption. There again, if we use the lifetime exemption, we have to file a gift tax return. No taxes paid, but we've moved a significant chunk of money out of the estate, away from the estate tax, away from creditors, and it's now protected, but still in the family. We can have a loan from the family or a third-party loan. There again, premium financing, either traditional premium financing or private premium financing, all works. The loans, we just have to make sure have the AFR rates, appropriately allocated to the loan, and loan documents in place to document the proper loan. We can use grants or sales to a defective trust. Again, these are great tools. They're a little bit more sophisticated in the planning, but it gives us the opportunity now to set up a trust. If we need it for estate tax, great. If we need it for asset protection, great. If we just need it for family planning, that's great. All of this can be done. We just don't want to inadvertently trigger a gift tax while we're doing it. So life insurance trusts are an exceptional tool. They can be used for more than just estate planning. I mean, for estate tax and tax avoidance, but we can use them for so many more things if we need to. So if you have questions, feel free to reach out. I appreciate you getting on, and we'll talk again next week.